Hey you guys, what's going on? It's your big dreamer and doer G Dinero coming to you today to break down the trade. But first, remember, none of this is financial, tax, legal, investment advice. It's your buddy G Dinero helping you increase your financial literacy to help set you and your family on that path to financial freedom. So let's dig right in. So this came out just a few minutes ago. James from Invest Answers said that he added 1.6% to his Tesla bag, still working through his cash, bought it $235. So Tesla was at $235 at the time, right before the end of close of business today when the earnings were going to be released. He got into the synthetic long for $23.01. He's playing the long game, he said, out to 2027 and happy buying at these levels. While on the earnings call, we could crash to 200, he said, but the SPX, the S&P 500, is already rebounding, and he believes the odds are good or in our favor that we are close to the bottom. Also, there was monster call option buying today, which is bullish. I cut that off, but there was a ton of call option buying today. So a lot of people banking on this is the bottom for Tesla, and it's up only from here going out per this trade alert. This is what the chart looked at the time. Ignore my little kill zone thing there, but you'll notice that in the if you look on the bottom right-hand side of the chart there, you'll notice that it looks like we've just been bouncing along at that 215, 220 level. If you follow me for my TA Tuesdays, I've been talking about that over and over, saying that could be the bottom. That's a good, strong level of support right around 220. Could we break down and go down to 200? Yes, I've said that on the TA Tuesdays. Could we go all the way down to 175? Only in an absolute worst case scenario, but yes, anything is possible. So that's the setup on the chart. There's mild buying signals on the chart, I would say, right? I mean, it's slightly mean reverted to the downside. We do have some green mean reversion dots. It is kind of going down into that 215 to 220 range and rebounding off of that. So there's always that risk, right? Whenever I'm looking at doing synthetic longs, typically I'm waiting for like just great buying signals like we had back there at the beginning of March when we bottomed out. I think it was on March 10th. You can see there's a buy signal, a buy triangle there, the giant green mean reversion dots, and it bounced back up to the upside and actually swung back up to 300 right afterwards after hitting a low of around 215, I think, on the 10th of March. That's when I'm looking to go into synthetic longs, but I also don't have a ton of margin available. If you have tons of margin available like James does, or cash available because he's been selling off his MicroStrategy, that could be the reason for going into a synthetic long today. So what did he do? Invest Answers sold the June 17th, 2027 Tesla 230 put for $69 a share. That's approximate. Again, I'm going in and basically taking a look at what was the pricing throughout the day, and I'm trying to get that net difference of around $23.01. He never really tells us exactly what he sold the put for or bought the call for, but it was he sold the put for somewhere in that $69 range, collecting $6,900, using up $23,000 of margin to secure or collateralize the put due to assignment risk. What does assignment risk mean? It means when you're selling the put, you're agreeing to buy somebody else's shares for $230 a share on or before June 17th, 2027. So the entire time this trade is open, he needs to have the collateral available. It could be cash. It could be equity, from the shares, the margin that's created from equity in his shares and everything else. But he needs to have that available to secure or collateralize the put. Invest Answers bought the June 17th, 2027 Tesla 230 call for approximately $92.01 a share, spending $9,201 in the process. This resulted in a net debit of about $23.01 a share, or $2,301 per synthetic long that he put on. So he needed $23,000 to collateralize the put. It cost him $2,301 to put each of these on, and the break even on the trade is $253.01, which is the $230 strike price plus the $23.01 a share that he spent on the trade itself. This is what it looks like when you put it into Optionstrat. I just threw in like $600. Like, what if What if by June 17th, 2027, again, Elon saying that 2027 could be a huge year. I'm saying, what if Tesla kind of does a little bit more than a double from here? It goes up 150% from the current prices. And if it did so, it would get to about $600 a share. If it did that by June 2027, that's $37,000 that each of these contracts would be worth. The put would expire worthless. The call would be worth, again, around $370 a share. Times 100 shares is $37,000. You spent $2,300 up front, or $23 a share up front. This would result in a $34,700 profit, or you essentially basically 15x'd your money over the course of the next 2.2 years. Hopefully you found value in today's lesson. Make sure you check out my website, guys. Make sure you like this video. Comment below. What'd you like best? What could I do better? What would you like to see more of? Subscribe so that you can see more videos like this. Go to my website. Book a class so that you, or a course, so that you can get proficient in TradingView and technical analysis. The more proficient you are, the better trader you're going to become, guaranteed. If nothing else, do that. Book a course with me if you want to learn more about options trades like this. I have a whole course called Understanding Options. And if nothing else, book a individual appointment with me if you'd like to as well. That's at gdenarocoaching.com. And again, G Denaro, helping you increase your financial literacy to help put you and your family on that path to financial freedom. Thanks for tuning in, guys, and we'll see you next time. Take care.